Hey students, traders from around the world. My name is Jerremy Alexander Newsome. I'm the CEO of Real Life Trading, and welcome to the video on how to mitigate risk with credit spreads. I'm assuming if you're watching this video, you know a little bit about what credit spreads are. I'm not going to go massively into detail in this particular class about what a credit spread is. If you want to know a little bit more information about credit spreads, hop over to our mastery page, reallifetrading.com/master/. And these classes are the mastery classes. So they're a little bit more advanced classes. They are obviously free, like everything else on the website. And you can simply click on the video, watch a little bit about credit spreads, and understand what a credit spread is and how it works. But just to understand, the reason people do credit spreads is because a credit spread is a high numerical percentage win strategy. It's a mathematically percentage-based strategy in the equity world. And what you do on a credit spread is you pretty much ask yourself one question when you're getting into the trade. Where do I not want the stock to go? That's really what you're asking when you look at a spread. Where do I not want the stock to go? And before you're getting into a spread, it's really semi-simple. Even if you're not the most advanced trader in the world, you come up with some support and resistance lines, some pretty common ones. So this is Macys, for example. And if we zoom out a little bit farther on Macys, you can kind of see that there is a pretty obvious support and resistance line on Macys. So the support is 55 and some change, and the resistance was once, 63, and that's currently playing out as a support right now. So old resistance, new support. So if I were to come in here in Macys and look at this particular chart, I would also kind of notice that the stock is making a little bit of higher lows. So let's take, for example, we'll draw a little bit of a line, looks like this, and we can see that the stock went from here, from here, from here, here's a higher low, and it's bouncing. So it's making higher highs and higher lows. So in this particular situation, would we agree then that Macys is a little bit more bullish than bearish? And I think you guys would agree that it is just a hair more bullish than bearish. Okay, great. So we have the direction on Macys. Number one, when doing a credit spread, it is very important to do the spread in the direction of the primary and intermediate trends. Now, what is the primary and intermediate trend? Well, a primary trend is a trend that's lasting more than a year. So let's look at the last year of Macys, and let's look at a line chart and answer me this question. Over the last year, so let's say February 2014, which is right about here, what has Macys been doing? Going up, going down, or going sideways? And if you said, well, since 2014, the exact same time, and you draw a line to 2015 today, it's obviously going up. Now, it's not going up massively, but that is over a 10% gain in the stock, very close to 20% actually, in the overall gain of the stock. So it obviously is going higher. So bullish would be the answer. So the primary trend is going bullish. Now the intermediate trend is the last few months. So what do I mean by the last few months? Well, approximately the last 7 or 8 months, 6 to 7 months. What is the intermediate trend doing? And if you're saying the intermediate trend is sideways to bullish, I would agree with you there as well. And that is really what you want to hear when you're asking the question, what is the primary and intermediate trend? You want a little bit of sideways action. If you're getting a little bit of sideways action, this is probably a good trade to do a credit spread on. Because if you're getting some of the sideways action, it's going to be likely a little boring. You're not going to make a lot of money on it quickly, and therefore it's probably best to do a credit spread on the trade. So when you're looking at a credit spread, you ask the question, where do I not want the stock to go? So let's look at Macys, and here is the number one rule. When doing a credit spread, it's very important to do the spread in the direction of the primary and intermediate trend. The primary and intermediate trend is bullish. Therefore, what type of credit spread would we do? We would do what's called a bull put spread. And again, I'm not going to get too in depth in this, but that is when you sell to open a put, then you buy to open a put lower, creating a credit in price. And the credit is all determined on the bid and the ask of the options that you're using. So again, you do need to get a little bit of understanding on options. You need to understand, why it's bullish, but most importantly, if you practice this virtually, it just takes time for this to play out. So let me just kind of explain to you what you would do. If you look at a credit spread and you ask yourself the question, where do I not want this spread to go? Where would your answer be? You guys are welcome to go ahead and answer that personally, but go ahead and just say it out loud. Where would you not want this spread to go? And if your answer is probably somewhere over here, I would agree with you. Right? The stock could, do this. It could do this. It could do this. It could even come down and do this a little bit. But our expectation is, since we have this angle of bullishness, we have this old resistance, new support, we have the wick of this candle right here, we have this short-term support of this price right here. We have 4 things that are holding this particular price up. Now, when doing a credit spread, it's really oftentimes important to try to find 9 things, or what I call 9 check marks, to determine why would I do a credit spread here. So I've already come up with 4. Let's go look for a few others. And this is where I'm going to pull out some very simple indicators. I'm going to pull up the 10, 20, and 50 exponential moving average. So if I do a credit spread down here, ladies and gentlemen, would you agree that the credit spread is below both the 10, the 20, and the 50 exponential moving averages, and those averages should hold up the price of the stock? Would you guys agree? And I'd say, yeah, absolutely. So that's at least potentially 3 more check marks, right? You have the 10, the 20, and the 50 acting as a support because the credit spread is below those particular prices. If you come over to the long-term moving averages, now this is another key aspect. Long-term moving averages, and I call these the 100 and the 200. You're going to ask yourself, okay, where is that? Well, if you're looking at the 60 credit spread, here's the 60 spread right here. That's below the 100 and the 200 simple moving average. So that's another 2 check marks. So if you're following me, you have this candle, you have this support, you have this trend line, you have this, you have the 10, 20, and 50, and you have the 100 and 200 holding this particular credit spread up at support. So you have 9 things going in your favor, plus a 10th one would be this looks like a Morningstar reversal pattern, plus an 11th one, you're taking the credit spread in the direction of the primary and intermediate trend, and there's a small little gap action on Macys, which again will provide a little bit of support for the stock. So what to do from here? Well, again, if you answer the question, where do I not want this spread to go? You would go ahead and begin to say, where's the safest place I can place the spread? When you're placing a spread, you want the credit spread to be as far away from the stock price as possible. So you really want it quite far away. So realistically, if you could take the credit spread and do it down here, that would be even better. But me and you both know you're not going to get any money for that situation. That's not going to happen. So you want it to get as far away as possible, but still bring in a good premium. And your next question now is, what's a good premium? A good premium is 8% to 18% for less than 4 weeks of time. That's a good premium. There's no real reason to do a credit spread if you're only getting 7% unless the time is very, very little. If you get over 18%, those are good spreads, but if you start getting a little too high, that means that you're probably too close to the price action. So we'll talk a little bit about calculating your potential profits in just a little bit, but that's a good premium, is 8 to 18% for less than 4 weeks of time. That's really kind of what you're going for. That's your goal. Now, if you're wondering what is a good premium for really, really short periods of time, it's going to be a little bit different because 8 to 18% is pretty dang high. So if you're doing, let's say, less than 4 days of time, the numbers are changing a little bit. It goes from about 4% to about 12%. That's the range that you're looking for if you only do 4 days of time. Now, I will go ahead and just give you guys this absolute disclaimer that if you are dealing with 4 days at a time, you really should be a more active trader. You should have the ability to go in, look at charts actively, follow them pretty much semi every day, and be able to keep a close eye on them. I would truly suggest, if you are interested in weekly credit spreads, join the live trading room, live trading floor, even if it's just for a few days or a few months or a few weeks, because on Wednesday in the afternoon, we have Weeklies Wednesday, and that's where we look for exactly that. We look for credit spreads expiring, somewhere between 3 and 10%. That's kind of our average goal for a weekly spread. So just kind of keep that in mind. If you really want to do a weekly spread, you need to be a little bit of an active trader. If you're stuck at your desk, it's going to be a little bit hard sometimes to get out of a position if you need to, when you need to. So just FYI. Anyway, so a good premium for less than 4 days of time is 4 to 12%. So let's go look at Macys really quick here. And keep in mind that we're probably going to get pretty decent premium because earnings is right around the corner. And earnings, if you go over to tradingview.com, we'll come over here and we will go to the edits tab, and I'll let you see where earnings is. That's what I like about TradingView. It's one of those really cool features that's built in. It appears it's the 24th of February. So this credit spread will expire before the before earnings announcement, which is really, really good. So if we're coming down here on Macys and we're saying, okay, here's the $60 credit spread. So we want to do the 60 and we want to sell to open the 60 level. So we would sell to open. There we go. So we would sell to open this particular price. And let's say that this is the sell to open 62 put. All right, that's trade number 1. Trade number 2 is you come down here and then you would buy to open the 61 put. And that, my friends, is called a bull put spread. You sell to open a put and then you buy to open the put below it. What that does is it creates a limited risk. So your risk is the difference between the two numbers. And you determine the two numbers, right? The two numbers are the strike prices of the option. You determine those values. It really is entirely up to you. Usually, mathematically, it's more effective just to do the one right below it, but it really is kind of up to you. So in this example, you can do the 62.61, you could do the 61.60, you could do the 60.59. The 60.59 is going to be the safest, and I'll show you why. So here's the 60, and here's the 59. And the 62 is right here, the 61 is right here, and the 60 is right here. So again, the farther away from the price of the stock, the safer the credit spread. So what is your maximum risk on this particular trade? Well, your maximum risk is going to be $1 per contract per share that you trade. So for example, if you do 10 contracts on this trade, you're risking $1,000. So if you're doing 20 contracts, 20 times 100 shares per contract times $1 is $2,000 of risk. And that's really the way you calculate risk. That's the way I calculate risk. So I'll kind of give you guys that formula and you can write it down. So here's the calculation of risk. Risk equals difference in strike prices times amount of contracts times 100 equals total margin on hold in account. So there's your risk. The difference in the strike prices. So in this case, if it's let's just practice it here. And let's say we're doing a 65 put. And a 65 put would be very aggressive. That'd be way, way up here. So if you sold to open, if you sell to open the 65 put, notice that now you're selling this put right here. How many check marks are you going to get for that put, for that particular trade? Well, not many, because now you're above the pink line, you're above this blue line. there's not a lot holding out. You might get 1, maybe 2 check marks at max. And you really need to go for 9. You need to go for 9 levels holding your trade from getting in trouble. So the risk equals the difference in strike prices times the amount of contracts times 100 equals total margin on holding the account. So in this example, if you have, let's say you do 10 contracts, what is the risk on this particular credit spread? Go. The difference between the two numbers is 6. Okay, so 6 times the amount of contracts is 10. So that's 60 times 100 is 6,000. So you have a $6,000 margin on hold in your account. So let's go ahead and drop it back down here to where it is the most safe. Sell to open is 60 put and buy to open the 59 put. So we're going to come over here to the option chain and see how much premium that would be. So you always sell at the bid, and notice that we could only get the next one down is the 57.50. So notice that you always sell at the bid, which is going to be 8 cents in this case, and this is 8 cents. So we're not actually going to make any money at all for this particular credit spread. There is some money that we can make, and I'll show you. You could do a limit credit of some point. But what I'm going to do is we're going to assume, for the sake of discussion, buy to open. I'll try to find another one in a second. Buy to open the 57 put. We're going to assume, for the sake of discussion, that there is some money in this spread. The difference between the two numbers is 2.5. Okay, times the amount of contracts and times 100 equals total margin on holding the account. Well, that's how you get into the spread. Now, you're watching this particular video because you want to know how to mitigate risk on a credit spread. So let me give you my particular formula. This is the way I do it. This is the way I've done it for a few years now, and it works, in my opinion, very well. And at some point, it just all comes down to knowing where and when to exit or unravel your particular credit spread. I'll talk about the difference in just a few moments. So here's how I do, and here's how I define risk for my credit spreads. I take an account, let's say my account is $30,000, and I divide that into 4. I take a fourth out of that. So I allow only 25% of my account at any one given time to be involved in credit spreads. So if you take 30,000 and you take a quarter of that, 30,000 divided by 4 equals 7,500. 7,500. That means this is the total amount of money that I'm willing to use on credit spreads, 7,500. From there, what I do is I take this number again and I divide it into 4, because that's usually how many credit spreads I place a month, somewhere anywhere between 4 and 6. So I take 7,500 and I divide that by 4, and I'll come up with 1,875. Okay, so I divide that by 4 equals 1,875. That, my friends, is the maximum amount of margin to be placed on one given credit spread, 1,875. Now, in doing so, mathematically, with credit spreads, you win 70 to 80% of the time. And if you find a credit spread between 8 and 18%, you can do really, really well for about 7 or 8 trades. It's the trade that goes against you is the hard part. Because your goal in a credit spread, your main goal when you are in quote unquote trouble, is to not lose your fourth of margin. That is your goal when you're dealing with a credit spread. So in Macys, for example, we only have $1,875 that we could devote to this particular credit spread. So if we only have $1,875 that we can devote to this particular spread, remember, you calculate margin by the difference in the number, which is $2.50. So what you can do in this particular instance is take your margin, $1,875. You take 2.5, which is the difference between these two numbers. You divide out, you multiply it times 100, which is the amount of shares per contract, and you would come up in the situation with 2.5. 2.5, terrible math, 250. Okay, 2.5 times 100 is $250. So from there, if you have $250, that is pretty much the amount of contracts that you can take on this particular spread and staying under 1875. So if you take 1875 and divide it out by 2,500, you can do 7.5 contracts per leg, or 7 or 8 contracts. Your call, 7 or 8, because this is right in the halfway point. Because if you did 10 contracts, how much would your margin on hold be? Let's answer that question. 10 contracts. Well, difference in the two numbers, 2.5. 2.5 times 100 is 250, times 10 is 2,500. So you are risking now more than your allotted figure in your account. Is that making sense so far? Perfect. So this is how I define my risk for my credit spreads. My quote unquote R, my risk unit, is this figure, which is pretty much an eighth of your account. Now, yes, I agree that an eighth of your entire account is a little bit high. I realize that. But with credit spreads, it's not a directional trade. Credit spreads are a probability-based, numerical-based strategy. And bottom line, you are supposed to win more than you lose. And the ones that you do lose, you really, again, your goal is to not lose this entire amount. That is your goal. Because let's just say, for example, that you win a 10%, which, as I mentioned, is a very reasonable figure. You win 10% of this figure 9 times, and on the 10th time, you lose it all. Let me show you the numbers behind that. 187 is 10% of 1,800. So 187 times $9 is $16.83, minus your commission. So if on the 10th time you lose that entire figure, you're going to actually be down in your account. Not good. Well, let's say on the 10th time you only lose half of 1875. Half of 1875 is $937. That means if you do 9 out of 10 trades correctly, which is entirely possible, by the way, I do it very often. 9 out of 10 credit spreads, 9 go in my favor, 1 doesn't. If you can mitigate the risk on the 10th one to less than your entire margin, you can make money on this strategy consistently, month after month, year after year. You just have to learn how to mitigate your risk and trade your plan. Okay, so again, if you lose just half of your margin on the 10th one, that's $937 loss. And you can see that you made about $700 after commission. You made about $600 and some change, which $600 on a $30,000 account is 2% gain in a month. If you did this in a month, 10 spreads in 1 month, that's really not that bad. That's not too shabby. So again, another realistic goal is instead of 10% wins, let's say you're getting it around to my preferred, if you're doing a 2 to 3 week or 4 week spread, somewhere between 12 and 13. So let's just say you're doing 12%, okay? 1875 times 0.12 is $225 times 9. That's now $2,025. And let's say again on the 10th spread, because you will lose on credit spreads. I'm telling you right now, there will be a trade you will lose on. That's why I'm making you this video. If you do 9 trades and you make 12% on those trades, you'll make out of your account, $30,000 account, you'll make $2,025. And again, if you still have that one loss, which you will have, if you mitigate that loss to less than your entire margin, you'll make money on this account, or you'll make money on this trade. And same thing goes, if you do all 9 trades at about 12% return, and you do blow out and you lose the entire margin, which is very difficult, by the way. But if you lose the entire margin on the 10th trade, you still, at the entire month, would be about break even. You wouldn't lose, you wouldn't make, maybe after commissions, you might lose a little bit, but you would not have blown out your account, which I have seen happen way more times than I would like to. So ladies and gentlemen, it's all about controlling your risk in credit spreads. So this is exactly how you do it. You come up with your unit. This is a risk unit, so that's usually an eighth of your account is how much you're going to give on any given spread. Then from there, you come up with where the trade concerns you. That's step one. So step one in risk mitigation. Come up with where the trade concerns you. Okay, well, what the heck does that mean? Well, let's say that Macys comes down to here tomorrow. Are you afraid? Are you concerned at all? I mean, you shouldn't be. What if tomorrow Macys comes down and closes right here and you get a big black bearish candle? Are you now concerned? Well, probably a little bit. Okay, why? Well, because it closed below this trend line, it closed below this support line, and it closed below the wick of this candle. That means it took out 3 of your check marks in pretty much one fell swoop. So on a particular credit spread, what I do is I always come up with my one place where I will look at the spread. Unless the spread gets down there, I literally will not even look at it. I won't even worry about it. I won't even open up my account to take a peek at it. So in this scenario, in step one, I would literally write in, I will not even look at spread unless Macys closes below, and I'll find out this price, 62 on the daily chart. That's what I call my, my concern line. I don't even know what it's called, but it's just, that's the price that unless Macys close below 62, I'm not worried about this. Why? Because that's where the trade has begun to go against you. That's where this trade's breaking down a little bit, right? Ask yourself, where would I go bearish on Macys? Where would I go more bearish than bullish? And if you say to yourself, all right, I'm looking at the chart, and you know what? If we close below here, I would go bearish on this trade. If you say that and you can find that area, that's a really, really good point and a really good price for you to say, oh, okay, well, if I would go bearish there, then I should really be concerned about my bullish credit spread. So you come up with a line where you won't even look at it. So unless Macys closes below 62, you don't even care. Now, let's say it does. Let's say the Macys comes down and closes below 62. Well, that's just simply the price where you begin to look at things. Now, when I say look at things, this is the part that takes practice, and there's really no way around it. And I apologize, but this is not a get-rich-quick scheme. This is where you have to understand a little bit about sentiment. You have to look at gaps. You have to look at the hourly candles. You have to look at candles themselves. And you have to understand a little bit about the sentiment of the trade. Now, that's where real life trading and the trading floor comes in, is because I take requests from anyone in the live room. So if you come into the live room, or if you're a student and you want me to look at a particular spread and you email it to me, I'll look at it that way. But I take requests. So if you're in a spread and you ever want help with the analysis on it, just sign up for the trading floor at some point and just ask us, and we'll be happy to help you. But the way it works is you do have to kind of understand a little bit about sentiment, gaps, and candles. You just do. Because that's the point that helps you know where you should and where you should unravel. And what I mean by that is, let's say tomorrow morning, Macys opens right here. Well, if you go to real life trading and you go look at gaps, what type of gap is that if Macys opens tomorrow at 62.10? What type of gap is that? That is called a gap and go. Why? Because the prior candle is white and it is gapping below a support or a pivot line. So if you're in a bullish position and the stock creates a gap and go and it opens, you're probably going to want to start considering to get out of that position. This is the part that comes down to the biggest and the hardest oftentimes to manage, is the exit versus the unravel. Exiting a credit spread is when you buy to close the leg you sold. I'll put the option to make it more simple. Buy to close the option you sold and sell to close the option you bought, exiting the trade entirely. That's what an exit is. So ladies and gentlemen, let's say that this particular credit spread expires February 20th, which it does. And Macys comes down, and on the 16th, it closes below your price where you now begin to look at the spread. Okay? What do you do? Well, in that case, if you have 2 days left, it's probably best just to exit the spread. Why? Well, credit spreads work with time. The more time that passes, the more money that you make. Your goal is for the stock to be as far away as possible from the option that you sold at the date of expiration. That's your goal. So if you are coming with less and less and less time and the stock starts to get near where you're concerned, it's often good just to simply exit that credit spread and mitigate your losses entirely. Just get out. Because if you're really, really close to expiration and the stock comes into your quote unquote concerned line, you won't lose a lot of money the vast majority of the time. Because a Greek called theta will have already done its job. Okay? So you won't be absolutely hosed on that trade if it's close to expiration. You might lose a little, but you won't. You lose your entire margin in the majority of cases. Okay? So exiting a credit spread is you have initially, when you got into this trade, sold the 60 put. You now go and you buy to close the 60 put. And at the same time, you sell the 57.50 put. Literally exiting the entire trade, removing your risk, taking it off the table, and you're done. You're finished. It's over. Trade's gone. You're protected. Everything is fine. You're good to go. Call mom, eat some crackers, have some pretzels, watch TV. Everything is fine. Now, there's a difference between exiting a credit spread and unraveling. So, here's my rules for exiting. It's best, easiest, and less stressful to simply exit a credit spread in the week of expiration if your loss is the same as your gain. That is a very, very good rule to live by, ladies and gentlemen. So remember, let's say that you were going to make your margin on this trade is 18.75. Okay, that's your margin. And 3 days before expiration, the stock comes down and it closes below your concerned line. And initially on the trade, you were going to make 10% of your margin, or $187. Now you're at a $187 loss. This, ladies and gentlemen, is called a 1-to-1 risk to reward ratio. You were willing to make $187. Now you're down $187. The stock has passed your concerned line, if that's what you want to call it. Just exit the trade. Because all you've done is lost the amount that you were going to gain on the trade. That's all you've done. It's a 1-to-1 risk-reward ratio. And if you can do that on the 10th trade, so remember, 9 out of 10 trades usually go in your favor, and there's that 10th that goes against you. That's really oftentimes how it happens. If you win the first 9, and on the 10th one, you lose your $187 that you're going to make, you're going to absolutely crush it that month. You're going to do phenomenal. You're going to grow your account 4 or 5%, mathematically. I mean, it's a really, really good month for you. That is right there one of my plans, and I stick to that very, very often. It's best, easiest, and less stressful to simply exit the credit spread in the week of your expiration if your loss is the same as your gain. And sometimes, if it's twice as much as your gain, it's still sometimes a good thing to answer. Because really, what you have to ask yourself is, am I willing to lose $350 or would I rather lose $1,875? Remember, in credit spreads, your goal is to not lose your margin. That is your objective and nothing else. That's really your objective. Because numerically, all the stock has to do is stay above 60 and you'll make money. Stock does this. I mean, shoot, it could even do this. You're going to make money. As long as it stays above 60 on the day of expiration, you will make your money on this trade. The option will expire and it will go to option heaven. So always ask yourself, how much am I going to lose on this trade? And is it better taking this loss or taking the entire margin loss? And if Macys doesn't close below 62, don't even worry about it. Don't even look at it. Move on and all is well. So that's exiting, and that, ladies and gentlemen, is my plan for exiting a credit spread. It's best, easiest, and less stressful to simply exit in the same week of expiration if your loss is the same as your gain. Now, unraveling is where it gets fun. Unraveling a credit spread is best accomplished when A, the stock has a lot of room to move, B, your, how should I say this? The time remaining on your spread is more than 4 days. Very important. C, there was a gap, strong candle, or a lot of volume giving the trade an edge. And that, ladies and gentlemen, is as simple as it gets. Unraveling a credit spread is best accomplished when the stock has a lot of room to move, the time remaining on your spread is more than 4 days, and there is a gap, strong candle, or a lot of volume giving the trade an edge. So what do I mean by that? Well, again, let's say that you get into this Macys spread and the expiration is February 20th, which it is. And tomorrow, Macys opens at 62. What do? Do you exit or do you unravel? And hopefully you said unravel. Because in this example, there was a gap. There's a lot of volume probably. There's more than 4 days and the stock has a lot of room to move. How do I know that? Well, support resistance. Here's resistance. Here's support. Here's target 1 and here's target 2. It has a lot of room to move. There's not tons of things in its way. If it gaps, oftentimes, and you have more than 4 days, you're probably going to consider unraveling that spread. Now, here's all you have to do when you unravel. It's very, very easy. In this example, you sold to open a 60 put and you bought to open a 57 put. All you do is you go in and you buy to close the 60 put. That's it. You buy to close the 60 put, getting rid of your obligation. That's going to cost you money. And now you have a 57.50 put. And now you're just hoping that the trade goes down and you can get out. That's really about it. It's that simple, ladies and gentlemen. From there, it simply becomes a regular trade. It becomes a regular bearish trade with a put. right? So you have a put that doesn't have a lot of time on it. So your goal is for this stock to continue lower. And if it doesn't, exit it at some point. And if it does, and you're beginning to make a profit on the overall trade, exit it. So here's the way it works, and I'm going to put this numerically for you, best I can. If you originally sold the 60 put, sold to open, you would have brought in, and let's just say, this is a hypothetical figure, but it's probably going to be pretty close. You would have brought in about, I don't know, let's just say $1. $1 of premium. Now you can see right now on Macys, if you do this exact trade, you're bringing in like 8 cents. That's why we're not going to do the trade on Macys. But you would have brought in $1 of profit. I'm going to make this green. Now, the closer to expiration it happens, the less it costs to buy back. So what I mean by that is, if this stock gaps down here tomorrow, this option would probably cost you $3 to buy back. If this gap happened, I don't know, the 13th of February, it'd probably cost you about $1.20 to buy back. It depends on how close you are to expiration and how much money has been lost on the spread because of the time decay. So as long as the stock stays above 60, you're going to make your money on the trade. If there's a lot of time on the trade left, it's going to cost you more money. So this is the way this works. It's very important to keep an eye on how much it costs to buy it back, because it's going to cost you money. This is money that's going to come out of your account. So if you sold it for $1 and you're buying it back for $3, you're losing $2 per contract in your account. So if you did 10 contracts, that's 1,000 shares. You would be losing $2,000. True story. Okay, you'd be down. You'd be losing money. However, you have a put. And that put now, okay, when you bought it, you spent money. And when you spent money, you probably spent less than $1. So I'm going to say you spent 75 cents. That's how much money came out of your account. So ladies and gentlemen, let's say if the stock gaps down and opens here and goes from 60, it opens at 62. You have to buy to close the $60 put that you sold, and it's going to cost you money. However, you originally bought a $57 put as well. That put is going to go from $75 cents to approximately $1.25. So it's going to increase by 50 cents. So far, you're really only down $1.50 so far, which is good, right? You're mitigating your losses. Therefore, your goal is for the stock to go down enough so that you can do what? Well, you have a put. Your goal is to sell to close the 57.50 put. That's what you do. You sell to close the 52.50 put at some point, and your goal is to do so for the difference in price. So you want to move up another $1.50, which is at least $2.75. That's what you do. So when you originally buy the put, it cost you 75 cents. When you originally sold the put, you brought in $1. That gave you a 25-cent credit, aka 10% return on your investment, because your margin is $2.50. right? The difference between 60 and 57.50 is $2.50. If you're making 25 cents on the trade, that is a 10% return. So in this example, you sell the $60 put, you bring in $1, you buy the 57.50 put, and you cost you 75 cents. You're not going to touch this trade at all unless it closes below 62.50. Well, by golly, the stock market gods are mad at you. The next day, the stock opens at 62.50, and you say, all right, Jerremy says there's more than 4 days in the remaining in the expiration. There was a gap, there was a strong candle, there's a lot of volume, and the stock has room to move. I'm going to unravel this spread. So you simply buy to close the $60 put. That's all you do. You buy to close the $60 put, and you're done. Now, all you have remaining is this particular put that has already increased a little bit in value, and you're hoping that since you analyze this as a gap and go, you're hoping that Macys continues lower and you can sell to close the 57.50 put for X amount of dollars. Your goal is to at least break even on this trade. That's really your goal. Sometimes you can do much, much, much better. I mean, let's say hypothetically that this was a gap and go, boom, tomorrow, and Macys comes down to $56, okay, by the 18th of the month, you'd have a pretty good value left in your put. It would be worth more than 75 cents. Guaranteed. So that's how you unravel a spread, and you don't even worry about unraveling or exiting if your line does not get crossed. So let's go ahead and get rid of some of this, and I hope you guys enjoyed that information. It does take a little bit of practice, of course, but let me do something, and I'm going to show you some credit spreads that I have going on right now so you guys can see what I'm referring to. Okay, let me go to IWM. In IWM, here is my exact thing that I just told you guys about. I have a 112, 111 bull put spread. I will not even look at this spread unless it closes below 114.20 on the hourly. Here's 114.20. We have not closed below that price. Therefore, I have not even looked at this particular spread. The 112 spread is right here. So, ladies and gentlemen, let's say tomorrow I have a 112, 111 put, and tomorrow morning, IWM, which is the Russell 2000, has a huge gap, and we open right here at the red line. Would I unravel or would I exit? And the answer is I would be looking to unravel because I have more than 4 days to expiration. It happened with a gap. And there's not a lot stopping IWM if we break this support line. If we break the support line, there's a really, really good chance it's going to come down, who knows how far, but it's likely going to come down. Now, I have the same strategy up at the top. This is called the bear call spread, and I have the 123, 122 bear call spread. So since I have both of these on, it's actually called an iron condor. So my spread of this is, I'm not even going to look at the spread unless we close above 1950. 119.50, which is right here. So we're getting close to that, but it hasn't happened yet. So unless it happens, I'm not even going to look at the spread, consider it, not worry about it. Everything's going to be fine. However, I have that particular price. I have this particular line. So I have two lines holding this bear call spread back from being profitable. So I have this resistance right here, and I have this blue line right here. And you guys can see this blue line's been a pretty strong resistance for quite a while. So boom, boom, boom. So the closer we get to expiration, I'm going to need IWM to close above 120.57 for me to even be concerned, because 122 is the option that I sold. And 122 is right here. So again, if IWM closes really strongly above this resistance line tomorrow, I would likely be getting ready to unravel, because there's nothing stopping IWM if we close above this resistance. There's nothing in the way, and I have time, and if it happened with a good gap, and a good volume, and a good candle, and I have time, then I would unravel. If I don't have time, what do? I just exit the spread. So that's the way, when you guys, by the time you watch these videos, you'll see if this trade worked out. Bottom line, if IWM is below 122 and above 112 on February 20th, I made about a 23% return in about 3.5 weeks. It's not too shabby. Let's look at another one. This is Adobe. This is one that we've been in for a while. And again, 67.50, 65 bull put spread, bringing in 30 cents. So ladies and gentlemen, true or false? This particular credit spread brought in more than 10% ROI. And the answer is true. 25 cents would have been 10% ROI. So here was my line, 68.83. If we close below 68.83, consider unraveling. Why? Who can tell me? Well, that's because you have a resistance, you have a level, you have a gap, you have a support, you have a wick, you have all kinds of stuff holding it up right here. So if Adobe closed below 68.83, there's not a lot holding it back. So I would consider unraveling it if we just simply close below that price. But right now, looks like everything's going to be just fine on that particular spread. Let's go do one more. Monsanto. Monsanto, same thing. I had a 113, 112 February week 1 bull put spread. That expires this Friday, so in about 3 days. I also have a 123, 125 bear call spread. So again, notice you have a resistance right here and you have a support right here. These lines in blue, these are my lines that I'm watching if it gets above, and if it doesn't, I'm not going to worry about it. So 114.65, if we got below Monsanto at 114.65, I would have looked at it, and this is 123. And if we get above there, I'll look at it. Otherwise, I'm not going to touch the spread. I'm going to let it do what it's going to do, and that's that. LinkedIn was the other one. So again, you guys can see these are examples. Oops, LinkedIn expired last Friday. Sorry about that. Well, anyway, I had a bear call spread up here, and we had a bull put spread down here, and both of those expired last Friday. That was an iron condor, and that was approximately a 15% return. So let's see if I can find one really quickly that is expiring. SPY. You know, SPY would probably be a really good one. Here's what I would consider doing on SPY. And you guys can set this one up and look and see how it worked out. But bottom line, what is the intermediate and primary trend on SPY? If you're saying bullish to sideways, I agree 100%. That's why it's time for a credit spread. So we're going to want the credit spread below this support level, as far away from the credit spread as possible. So the fact that we have a gap right here, the fact that we have a bullish candle, the fact that the stock is above the support, those are 3 check marks. The spread will be below the 100 and 200 simple moving average. That's 3 check marks. We're also above the 10, the 20, the 50. So that's 9 check marks, ladies and gentlemen, on the SPY. We're done. So let's hop over here to the SPY and let's find out a credit spread. We're going to do a bull put spread since the primary trend is bullish to sideways. We're going to come in here to February 20th and we're going to get as far away from the stock as possible. So the stock is, we're going to come down here and we're going to do a 190, let's see, 196, 195 bull put spread. And if we do that at market tomorrow, that's going to be bringing in approximately 7 cents. 7 cents on a dollar is 7% return for 3 weeks. Remember I said my kind of cutoff is about 8%. So what I would do in that situation is I would do a 196, 195 bull put spread. I would do that for a limit of 8 cents. And I would simply say I will not even look at this spread unless we close below 197.51 on the daily. So keep that in mind as far as your practice is concerned of just when and where to unravel. And I'll show you guys the most recent unravel of the credit spread is on MU. And on MU, We were in a 28-27 bull put spread that was expiring this week. And we unraveled that particular spread based on the gap and the candle and the volume back here. So right now, we are breaking even on the spread or losing very, very little bit. So since we unraveled the spread, right, which means we had a 28-27 bull put spread, we bought to close the 28, and we still are holding on to the 27. We're still holding on to that. We are, and we can put a stop on our $27 put that we're still holding. And the stop is $29.11. That's the stop price for the put. So if, right, MU does not continue to go down, if MU does go up, we're going to exit out of our 27 put that we're holding on to. And bottom line, we will have taken a loss on this bull put spread, but it was absolutely, without question, less than the margin. If I had to be honest, if we were to, overall the margin was $1, I think, if MU goes up this week, we'd probably end up losing about 40 cents on the spread. So a little bit less than half of your margin. And truth be told, this is the first credit spread that we've lost in about a month and a half. And I set up probably about 30 credit spreads a month. So I think we've gone 2 were break even, which were both on Netflix. 27 have been profitable, and this will be the one that we're going to lose on if it goes up. If it goes down this week, we still have the opportunity to make a little bit. We're probably not going to do very well, but if it just absolutely free falls, we'll do very, very well. But right now, on MU, we're not looking bad. So again, if we have just a 30-cent loss, as long as we lose less than our margin, ladies and gentlemen, that is the key. And I truly do suggest, if you ever have any questions about unraveling, join the trading floor, ask questions, get your hands dirty, practice, do a lot of virtual trading. And the truth of the matter is, ladies and gentlemen, it just takes time, it takes practice, but it takes creating a plan. So write down what your plan is on any given credit spread, simply follow it, and I really do hope this video is beneficial. If you have any additional questions anytime, feel free to reach out to me at jerremy@reallifetrading.com. I do truly enjoy you taking the time to watch this video. Thank you so much. Have a great day. Tell everyone you know about real life trading, because guys, we're giving away this information for free. This video by itself is worth at least $400 in value. I know countless companies that would sell it for more than $1,000. So just understand that we want to enrich lives. We want to educate and help people from all over the world. And it all starts with you and the word of mouth and you giving people the information of real life trading and sharing it widely. So thanks so much, guys. Have a great day. Like us on Facebook, subscribe to us on YouTube, follow us on Twitter. And until next time, remember, love life, live life, and trade it. I'll see you later.